Hi, this is Randy Finney with Right Side of the Chart, and today's Tuesday, June 20th, 2017. I wanted to do a quick overview of everything that I'm looking at. I'm not going to spend 20 minutes on any one sector or any five stocks. I would just kind of do a quick overview of the broad markets. We'll just stick with the daily time frames, won't get into depth in these charts. Share my charts. I'll share my thoughts and my charts as to really where I see opportunities right now and where I see the broad market going. And again, I talk about the broad market a lot, and although I don't trade the broad market that much, the broad market, particularly we're talking about the S&P 500, an index that's very diversified. As I often say, if you go long, you're going long the most bullish and the most bearish sectors and stocks, and there's such a diversity, defensive issue stocks, dividend paying, etc. So again, it gives us a guide to what the overall trend might be, how long this trend may continue on the upside, or if we'll get a reversal, which I still strongly believe we do. All right, so let's just start out. We're looking at the S&P 500 tracking ETF, the SPY, and these are sort of like Rorschach tests. When you look at a chart, a Rorschach test, those are commonly referred to as ink blot test. Everybody sees something different when they look at an ink blot. And you may look at this glass half full saying, wow, this is a market that just refuses to roll over, just keeps going up. Or you may look at this, as I am at this point, as a market that appears to me to be out of gas. What I mean by that, we're trading right around new highs, right off new highs. So how can I say that statement? Well, first of all, remember where we're at. And again, when I talk about the broad market or the stock market, one of the best indications is the S&P 500. So what I did is I grabbed that March 1st, that was March 1st high back there. And we're up a whopping 1.3% in the last almost 4 months now, if you look up the pop-up box to the left. So what I did, again, I grabbed this high back from March 1st, dragged it to today. So the market's barely up over 1% in almost 4 months, meaning that we've gone nowhere. So my point is, personally, I see a market that appears to be running out of gas, especially considering this. Let's just highlight this. We recently broke out to new highs. We took out that March 1st high. You can see it was resistance. There's the March 1st high right there. Here, I'll tell you what, we'll go to a clean board so you can see this a little bit better. Let's get rid of that line and this line here. Okay, and I'll make my point real quick. There's the March 1st high. We failed there, came back, and it was resistance as previous reaction highs often are. And we failed to break through. Finally, we did break through. This was a breakout right here. This was a breakout. And, I've a couple criteria you look for breakout. Number one is volume expansion. Number two is impulsive price action. And number three is follow through. Sometimes you do break out and back test and then go on to move, and that is still very much a possibility. But what I see is a very anemic, extremely anemic follow through to that breakout. Again, as I pointed out, we're only just over 1% above the breakout level, really, which was that March 1st high and the subsequent highs right here. So I see a market that doesn't have any gas left in the tank. Otherwise, a breakout like that should have seen, it's been several weeks now, we had enough time to consolidate the back test. We should have seen an impulsive move higher if this was the real deal. Okay, just again, my thoughts. And, I share things such as these divergences, these negative divergences. As I mentioned, they are confirmed. We have a bearish crossover on the daily PPO, RSI, everything else. So again, nothing I haven't talked about before. And we're just going down the line here. And we all know the Qs were really the strongest sector after since the elections. We had that big run up, and we had a breakout, several breakouts. We had a trading range right here, a little consolidation range, and then we broke out, and that was impulsive. Came back in at a little pullback, pushed back up. But I've talked about this. This was a huge bearish engulfing candlestick that we had Friday before last, and we've yet to even come to regain half of that move down from Friday and into Monday's lows. So a very anemic bounce so far. Oh, sorry, I had to pause it there for an interruption. Either way, that's it. You can see a breakdown, and we had some bearish candles in the last few months. But what happened? Remember this candle back there, March 21st, a big bearish engulfing candle. And you guys have heard, if you followed the site for a while, you've heard me say this dozens of times over the years. Any single bearish candlestick, whether it's some type of doji, a bearish engulfing candle, you need to see follow-through confirmation. We never got that with this candle. You can see the next day we closed up green. We never moved below that bearish candle, so there was a lack of follow-through. The market held. That's not the case here. We followed through to the downside. We were, from that move, is the biggest drop in years, that 2-day drop. I'm sorry, in many, many months, I should say. And so far, the follow-through has been extremely lackluster. This looks like a period of consolidation. We're under support. We have negative divergence, everything you like to see. I'd rather be wrong and stick to what what's worked for me many years, and that is simple. It's a combination of many things, but first and foremost, price action. As I'm showing you here, the leading index is broken down. The generals were all taken out and shot, all 5 of them, the FANG stocks, FAAMG, and QQQ is on a breakdown and has yet to recover. And if it does, if it can rally up and get back above those previous highs, well, that will be just show you that this market has a voracious appetite. A lot of buyers left in, a lot of pent-up buyers, pent-up demand in the market. And so let's just see what happens. As of now, it's not looking so good. And then we have, just to wrap up on the indices, I'm not going to cover the mid caps here. There's tons of different indexes. We'll come down to the other end of the range, the small cap stocks. And again, another story of this is a 7-month plus, or are we going on over 7 months now? Is it, let's see, at this point, that trading range, 6.5 months, I'm sorry. We had a breakout attempt back here a couple months ago in April. It failed. It took us back to the bottom of the range. Then this was a breakout. I mean, we took out those previous highs, but that breakout failed, as I suspected it would. I stated at the time. That was followed up with a bearish cross on the PPO, confirming this big, powerful divergent high, and now we're back in the range. Now, I'm going to say this. This is still, I'm not jumping all over the bearish case yet in IWM. I am short. I've told you guys for months. I keep, shorting. Well, don't add. I've had a TF short. TF is the Russell E Minis futures, at the top of this range. I had a couple lots that I added, and as long as we stay at the top of the range, I'm about, even on that position, and I'm expecting a move down to at least the bottom of the range, and I would put extremely good odds that if that happens, if we go back down to the bottom of the range, we're going to keep going. We might have a little reaction there. It's still a very well-defined support level. I mean, in the broad markets, major index, you don't see this. I pointed this out before, that the Bollinger Bands, it's the tightest pinch they've ever had in IWM on was it the weekly or the monthly charts? I think I covered on the weekly charts, meaning the price compression. 7 months of very tight sideways trading. And chances of that going on for 8, 9, 10 months, anything is possible, but it would probably be unseen for a major stock index with almost 2,000 stocks to trade sideways for, going on a year. So again, point being that failure, negative divergences. So what I'm watching for right now, it's too early to say this isn't just a back test of the top of the range. Yes, we're slightly inside of the range. But I often say this, that when we break out the new highs, it's been my experience that more often than not, instead of coming down and just back testing the top of the range and then taking off, usually those back tests, they bring you right down in the range. And what that does, whether it's the powers that be or not, it shakes out some of the longs that took the breakout, the weak-handed longs. It maybe gets some shorts excited to get them short covering. So I don't look at a move right back down within the range or right below the previous highs, the breakout point, which was, consider it here or over that previous reaction high. I don't consider that a failed breakout yet, technically speaking, but what I will and do expect is if we continue to move down in this range, especially impulsively, come back down to the bottom of the range as we did every other time, that will be a failed breakout. And again, fewer things in trading are more bearish than a failed long side or bullish breakout. So again, it goes with my theme here that I'm not seeing. I'm seeing a market that looks tired. You know, it had every opportunity at this point. At this point again, breaking out to new highs. The IWM, no follow through. The S&P 500, although it hasn't failed that breakout yet, we don't have any follow through. Financials I've talked on. This goes on the theme of breakouts. We have this multi-month trading range, and yes, that has not failed yet. We're still, you can see that very tight multi-month trading range. We're still there, but I did a separate video, and more so than just XLF by itself, I'm watching the big names, the leading stocks that make up the bulk of XLF, the financial sector ETF, and that's Berkshire. It's already met its close to meeting its measured target on that bullish falling wedge breakout. And then as far as the banks go, you know, JPMorgan Chase. Here's a breakout, a back test. And it hasn't failed yet, but again, lackluster follow through. You know, you would expect, we already broke out and back tested. And maybe it will take off and start really heading up and be off to the races. You know, from what I'm kind of seeing in the financial media and the blogosphere, I'm seeing a lot of bullishness, a lot of eyes watching the breakout in XLF, and I think there's just too many people on board the bullish financial trade. We don't have evidence to short it yet because it hasn't failed. But if you see these breakouts fail, especially the big banks, there's JPMorgan, here's Wells Fargo. Wells Fargo is yet to break out. You can see there's the downtrend line. Challenged it 3-4 days, couldn't do it, fell back. So it's pinched between support and resistance. What I'm talking about, this is a support level. You can see reactions from below, reactions from above, reactions back here, reactions back here. So this level, I'll give you the number on it, 53.64 is where I have my line. That's support. There's your downtrend line, which we failed at for almost a week to try to get through it. So watch for a break of this 53.64 support or a breakout, and then you have support right above. So I don't think Wells is going anywhere at this point in time. But again, we'll see. Here's Bank of America. There's a nice downtrend line. Looks like a little bit of almost a wedge type pattern, almost a descending triangle, a breakout. But again, the theme is the same, an anemic breakout. Very little follow through. We back tested, and we haven't failed the breakout yet, but we haven't taken out. You can see really what's stopping us here. See the gap right here in this area? We have a gap. We broke out. And I often talk about this. When I'm trading alongside breakouts, I won't take a breakout above a downtrend line or a horizontal resistance level if there's another resistance level right away, because this is what happens. You break out, if too many eyes are watching this line, but they're not paying attention. Gaps are like magnets. They're powerful, you know, support and resistance levels. So so far we're stuck between a rock and a hard place. In other words, we're trading inside that gap, and whichever way we break, a definitive break, convincing break, well, that side wins. And if we fall back down below that trend line, then that's a failed breakout. So I can go on and on with the financials. Here's Citigroup. Citigroup had this sort of like a rising wedge pattern, broke out. And I talked about this before. I see that's a big divergent high right there. I left this trend line as is instead of, you know, normally I might bring that up there. But we had quite a few reactions, and I talk about this a lot in trading, whether it's a bearish rising wedge or a bullish falling wedge. I talk about wedge overshoots. Right when you get towards that point, that sweet spot, you know, around 65, 70, 75% or so to the apex of the wedge, about where we are. That's usually where you'll get either a breakdown on the wedge or sometimes an overthrow of the wedge with a move back down inside and then down below the wedge. And the divergences tell me don't chase that breakout. And again, I'm not fighting it right now. I don't have the evidence to short XLF or the financial stocks, but if these breakouts fail, I will certainly have that. U.S. Bank. As you go down the line, a lot of these bank stocks don't look as good. They're not confirming. I think I had the charts freeze up here. There it goes. See, USB still stuck within its multi-month trading range. And just a couple more because they're big names. There's Goldman. Goldman's not going anywhere. Tried to break out, but like again, lackluster. Just just sloppy trading, if you will. That's not what you want to see on a breakout. Now, again, it has resistance overhead. So there's a big level to watch on Goldman is 228.63. All right, let's get away from the financials. It's the same common theme. You know, they have the bullish divergence in place. There's a potential for these guys to break out and run. I will say that. But right now, these breakouts have not been convincing, just like the stock market. Okay, enough bear speak for you guys. Let's now look at something that I've been talking about for weeks. And I cover XLE in my sector analysis. I often do videos or static chart coverages of the sectors that make up the S&P 500 and energy. Although it's not the biggest weighting, it used to have a much heavier weighting, but it's only about 6% now because energy stocks have been in pretty much a bear market. Especially going back for a few years. But I've been highlighting this level, and for a while, call it 63, call it 64, and I took my first position in XLE in a long time today. Grabbed a little bit here right after the open today. I can see a little more downside. Again, I have that line right at 63.93, but you can see how well defined it is. There's reactions all the way back here, reactions from below again there, reactions from above, reactions from above. So that's a potential reversal point. And I highlighted that scenario. I said until and unless this downtrend line goes, we do not have a buy signal. So a couple weeks back, I said your next buy signal is either on a breakout above this downtrend line or a pullback to this support level. And then you can go long with a stop not too far below. Personally, I only took a starter position. My confidence isn't high enough yet to add that as an official trade, but it may be very soon. There's also several energy stocks that stand out, some nice ones that support. I'll probably have to do a separate video or put those in maybe some official trade ideas. But when I go through the energy sector, I see some stocks that look like they have a little more downside. Maybe, and when I say a little more, I'm talking 3, 5, 6, maybe 10%, and then others that are at support now. So it's probably going to be a stock picker's market there, and basically, I just wanted to play a game of bounce. I might even exit instead of add to that position on XLE. It's up slightly so far. Just wanted to highlight that descending price channel here and this support level. And if that goes, yeah, there's going to be some minor supports along the way, 63.80, but we could fall quite a bit further on the energy stocks. So I'm not getting married to those at this time, but I do think that crude energy stocks, here's XOP, that's the oil and gas exploration and production ETF. There's a nice support level. You can see if you follow this line, let me give you a number on it, 31, right at about 31. And we shot through it. We're just a hair below it today. But you can see there's a gap, there's reactions back here, so that's a support level that I'm watching, and we might get a reversal on XOP. So bottom line is we could be at a bottom, and if not, I think we're close. I think the downside is probably minimal, and of the sectors within the S&P 500, this is one of my favorites, and again, just might need a little more work to the downside, especially if the broad markets start to sell off. And then I'm warming up to gold again. Here's gold daily chart, GLD, the ETF. You can see this line here. I'll give you a number on it. 118.34 is where I have that level. It's not a hard level. In fact, well, I could move it around a little bit. You can see a lot of reactions here, a lot of reactions there. There's a reaction low. So there's quite a bit there. There's also a big gap. So really what I'm looking at here on gold, it's hard to make a screaming buy case, but in trading, it's always an objective entry when something is near term or oversold. We've had a heck of a correction following this move up. There's a gap right there that I'm looking at. So we may drift down to the bottom of that gap. I'm going to show you where that would be. We'll use the highest point on that candle. So we're really in a support zone now on GLD. The daily PPO, this white line, the 90 MA is still bullish. It's above the 0 line. I like to see that, and it may be curling up here. So I think the risk reward is pretty good for gold and the gold mining stocks right now. Here's a 60-minute chart. You can see some support levels there. And then, of course, my preferred trading proxy, if you get the move right in gold, you get the usually you can do much better in GDX. It's simply a leveraged play on gold, if you will, the gold mining stocks. What am I looking at here? Well, we had a divergent low back here on the 60-minute chart. It started to play out. There's this downtrend line. So really, if you take this line, we have the purple lines form a almost like a wedge type pattern, and you can either buy down here at support. Let's show you that support level. You can see that line. Support here, support, and there's reactions. So if we come back down either to that white line or that purple line there, and that's around a little over the 21, we'll call it around the $21 level. That looks like an objective long entry. We could reverse before then. I could easily see that, as a matter of fact, because gold is coming up on support. And if not, that looks like an objective area to go long, like anything else, with a stop not too far below. Here's a support level below. It depends what your targets are. And then ultimately, I think the gold mining stocks are poised to head back up, test that line right there, that trend line, and then break out and run. I think easily they could run up to this, that previous reaction high around 25.80 or so, and maybe more when we look at the longer term chart. I'm sorry, that is a daily chart. Let's look at the 60-minute chart, see what we see there. This was a previous trade. I'm not sure if I posted an update. We finally creeped below that 2010 level. The previous trade on GDX, we hit the second out of 3 price targets. So you can see here T2 was hit there, T1 was hit. And at that point, we had a divergent high. We had negative divergence. That divergence has played out. We had an uptrend line here, which we took out impulsively. But we are coming up on support. You can see a nice gap right here. So we're at the top of that gap, which is support. If that level gives way, then we go and we probably backfill the gap, and that takes us down here to 2160, we'll call it. And that would be the next objective buy point or entry level for GDX. And that's it. Other than that, as far as long side trade ideas, as you guys know, being very selective on the commodities arena. At some point, commodities will have run their bear market, and then we can look at some of the commodity diversified ETFs like DBA. I made mention of JJG recently, which is the grain ETF. But right now, as you guys know, if you're following the trade ideas on the site, there's 3 specific ones that have recently been added as long trade ideas. Sugar, which is SGG, the symbol for the ETF. Coffee we added today, that's JO. And wheat is still an active trade, just hit the second target, I believe, WEAT. And I think we did soy, but we've been in and out of commodities over the years. They're hit and run. These are swing trades. The majority of trades on this site are swing trades. You get in, your targets are going to be hit anywhere from several days to several weeks, sometimes several months. Milk a move, get whatever it is, 10, 20, 30%, and get out and get back in. As far as long-term trade ideas go, those have been far and few between lately because market conditions, we're just not seeing, those things that have a lot of upside potentials like commodities and stuff haven't given me enough evidence of a bottom yet. So I'll swing trade even if we're in a bear market and I see a bullish falling wedge, and it might just be a bear market rally, but that bear market rally is going to go 10, 15, 20, 30, 40%. I'll trade it and then I'll get out. And that's been the trend lately. So if and when the broad markets show us some really strong evidence of that they've begun a new downtrend, we might see some official broad market trade ideas. But right now, my focus is on individual stocks and sectors, commodities, things like that. And if you guys have any questions, drop me a line. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.